insights to a really great financial future. Tom and Don are talking real money.
One of the biggest things that investors do, people who consider themselves serious investors, I'm serious about investing. I read my Wall Street Journal. I read my Investor's Business Daily. I read the New York Times. I read the Washington Post. I read whatever it is, Bloomberg, that thing. I watch Fox Business and CNBC. I'm paying attention. I know what's going on in the world of finance. I follow the news, so I am a savvy investor. Therefore, I am going to make better decisions because I'm ahead of the curve and all of the rest of you aren't. So, can the news, knowing what might be coming, the reports from companies, things that have happened to them recently, can that be a means by which you profit in the stock market? Hi, everybody. Welcome to Talking Real Money, the podcast. Don McDonald here in beautiful FLA, where it's, I don't know what it is today when this airs, but I'm pretty confident it feels like 108.
We're in the salad days here. It's a sunny and 75 every day.
Now it feels like 78.
Yeah, it's crazy hot. Really out there. So, crazy.
I'm telling you, I'm still trying. I think there's an escape to the mountains coming. We were going to go to Maine, but gas prices, I think we're just going to go to the mountains and park for a month. I'm not sure.
Okay.
You know, in the trailer, of course.
See, now when you say park to me,
not just in the car. We're just going to pull into a parking spot somewhere, spend a month there.
Okay.
See what it's like to be homeless.
Absolutely. Try it.
It doesn't sound like a fun thing. Anyway, what are we talking about? Well, we're talking about reacting to the news. Can you, as an investor, make decisions based on, a company's reports of better earnings, worse earnings, something terrible happening, something great happening, the rocket not blowing up as opposed to it usually blowing up or whatever it might be? Can you make decisions? Larry Swedroe, good friend of ours, wrote a paper on that.
Well, he writes an article, a daily vlog. I mean, I read it every day. It's good. And I think I pay something for it. I don't think it's free. So I think you got to pay to get this every day. And we have a bias. So the other thing was, I read this, I thought, if you would have to really work hard to convince me that markets in the long haul are inefficient. In other words,
okay, you're talking about the efficient market bias.
Yeah,
we believe that markets, but let's codify. Let's not codify. Let's focus that a bit. We believe that markets are efficient on a grand scale.
Yeah.
There are inefficiencies. The problem is trying to recognize, to identify, and then to use those inefficiencies and finding the inefficiencies that actually work. And I think that's kind of what this article is about, right?
I think it is about that. And you're seeing that. I think you're seeing that play out the last year and a half with people that have moved into international stocks, which have gone up more than U.S. stocks because they were kind of priced a little lower than U.S. Right. Okay. So anyway, Larry wrote recently about a new study that's called The Inefficient Pricing of News. And the paper suggests that the assumption of efficient markets that you just described on is wrong. Quoting Larry, mispricing is larger and lasts far longer than the academic finance world has documented. Now, they went back and looked at 6.7 million Reuters news articles over about a 25-year time frame ending in 2022. So that's a pretty decent amount of news, or is it? I don't know.
I don't think it is. I don't think 25 years is enough data points to draw conclusions because you're going to get a lot of recency biases in there.
Yeah, but what they found is fascinating. Researchers made an observation that seems obvious in hindsight, again from Larry, but haven't been formally tested. A lot of what we call news, they say, is predictable. Got to think that through a little bit. They found that there's about a 10%, it could predict roughly 10% of the variation in news content before the article is even published.
Wait a minute, what can predict that?
The researchers, if you just looked at generally, here's what you would expect this company, the things that companies most of the time report
you mean
as
that
news
SpaceX
are really not that
will
news.
have a rocket blow up?
They try not to report that. They try not to report that.
You can't miss it.
You can't miss it. And that had no material impact apparently on the price, which is skyrocketing. It doesn't seem to matter. So this, at the end of the day, what you said is absolutely 110% right. I'm going to say that 80% of the people that I talk to still think that's investing, that investing is reading all those things, is knowing what's going on in the world and what's going to happen, and is basing what I'm going to do in the next 1, 6, 3 months on that. That, we're going to tell you, is just a fool's errand, or from everything I've ever read or everything I know. But in this case, they're really talking about the news shock strategy. I'm not going to give you the number because Don doesn't want me to, but
well, I just don't think this ratio. I don't think this is a robust enough study to tell people that if you can find the right kind of news, it improves your returns by X. I just think that's misleading.
Or how to respond to that, right?
Yeah.
This is always the struggle once you think.
And we really need
something.
to explain what the different kinds of news are, because there's the news shock news, and then there's just the news, and determining which is the right kind of news.
And they mention negative news, and they say that bad news, this is quoting, travels slowly. Investors don't fully process the negative implications right away. And it also, again, kind of gets back to our bias of investors' reluctance to sell losers. Quantitative news.
Number news.
Yeah, number news, investors appear to underweight them because people like stories, as they point out. When I read this, I was like, yeah, people would rather have a story than they would a number.
Right. So what are they saying here? Let's just read between the lines. What they're saying here is that with just normal negative news or somebody reporting bad numbers that nobody pays any attention to, the market really doesn't react to that. So you can't play that news, basically. That's what they're saying. You can't play that news for a potential higher return.
And the overreaction, ambiguous news. They say investors overreact to uncertainty. High attention news, think the things Don just mentioned, rockets blowing up, etc. The initial price move overshoots, and then a reversal, they say, follows. This is looking back again 25 years of data at individual companies and news stories, if you will, news information.
This just sounds so complicated already to me.
Oh, I think it is. And I think there's open to a lot of interpretation, too, right, about what is news negative, is it positive? It's just news in many cases. I think it's hard to. But what they found, again, was, there's an edge to doing all this, but replicating the strategy is not realistic for most individual investors because you need access to, again from Larry, large news databases, sophisticated AI infrastructure, and the ability to trade hundreds of stocks with short horizon signals and manage the turnover. That sounds real easy, doesn't it?
I love that. I love that. They do all. Here's what we do in this business. We talk about all of this esoteric research. And we say, look at this. There is a correlation between X and Y, and yet you can't play it. It's like, yes, Warren Buffett was better at investing than you were for a while, but you can't do it.
No.
Yes, sometimes hedge funds beat the market, but you can't do it. You can't do this stuff. We spend a lot of time spouting a lot of hot air, and I'm sorry, I love Larry, but again, this is one of those stories that it's like, okay, here's all the things that could happen, but bottom line, you can't do anything about it.
He mentions AQR, the fund family, in here, somebody who could do it. It doesn't say they're going to do it, but it's somebody that could do it. But he mentions a couple of lessons. The first one's the market is less efficient than you think, especially around news events. I don't think that's a big lesson, Larry, because I think there's always reactions, overreaction, underreaction to news. But in the long haul, what does it really mean? But here's the part I really like. He says, be especially skeptical of your reactions to splashy, ambiguous news. I think that's a great thing to know because we all have a tendency to, I got to do something there. The story versus statistics gap, he says, is real and exploitable. In other words, the fact that people tend to respond better to stories than to numbers, and then finally don't confuse big news with new information. Much of what appears to be break news is consistent with what we already know about a company. confirmation, if you will. So by the way, I love this. He calls the the factor. Is this a factor? I think not. But he calls the whole aspect of the number of factors now the factor zoo. In other words, there's so many animals that are ranging there that who knows what's a reliable factor.
And that's why I love the statement from many, many years ago by Eugene Fama that there are all of these new ideas that come out all the time and that only a very few survive long-term scrutiny. Everybody's looking for the new thing. And I think AQR is a fund group that is guilty of that and guilty of exploiting that. Do you know what the average expense ratio is for AQR funds?
I think it's spendy, right? 0.5%?
Oh, you are so far away.
I'm not making enough money, apparently.
No. The average expense ratio was quoted by Portfolios Lab across the entire family at 1.44%.
Wow. That's
a number I believe that's a number that's almost impossible to overcome.
Right.
I don't know how you're going to consistently squeeze an extra 1.5% out of the market with these very esoteric factors, and I think they're just that. It goes back to this very human problem. We're trying too hard to think this stuff up.
Well, and he mentions that. He says, learn to be suspicious of your own reactions to news. The market's reaction to a surprise announcement is probably incomplete, right? They haven't really thought it through. What's this all going to mean in the long haul? We've seen that many, many times. Well, so at the end of the day, is this something you really need? I'm going to say no. Is this something we all want? Sure. Yeah. I want to know what XYZ Corporation, what that change downtown is going to mean to my portfolio, but it's not going to change how I invest. Number two, do we need a new factor of some kind? You'd have to have a lot more data and research to add one.
I want more time. I mean, I want them to go back 100 years. I do.
Exactly. Yeah. And
there's news. There are news resources from 100 years. You could take this study back. It would be very involved to do so, and it wouldn't be as robust because of the quantity of news. It was far lower in 1927 than in 2027.
Which we're quickly
willing
approaching.
to bet that there was a lot less news out there.
I think. You're right.
I kind of remember sitting around with the family in
1927.
No, in 1967.
Oh, okay.
We just watched Walter Cronkite.
And that's the way it is. The 252nd.
We never watched Huntley and Brinkley, and we never watched Frank Reynolds over there on ABC. That also ran network.
You like the Tiffany network? You're going to stick with them.
Well, it was Walter. Come on.
Captivity for those 52 American hostages in Iraq.
There would be no cable news.
At the end of the day, my big takeaway.
Doing it. What?
My big takeaway.
What?
Be suspicious of your own reaction because we have biases. We all have emotions around things, and people tend to respond, and that leads them to bad decisions. That I've seen many, many times.
Ignore the news. It means really, for a diversified portfolio, the news doesn't mean a darn thing. No need. Why waste your time? Do something more fun. Go to a soccer game.
Yeah, of course.
Are those over yet? We're getting pretty close.
Going.
No, it's July now. Yeah.
Yes.
Isn't it over?
Until July 19th. So
it's not over yet.
It's not over.
It's still going.
You can still watch very early American football. There's somebody's playing something.
No. The UFL's even done.
Is that done? Okay.
Yeah. So,
I didn't watch any of it. I'm sorry.
I saw some in a brewery I was in. I went, wait, Orlando has a football team? I did not know that.
Well,
have they been playing for months and I didn't know that? Apparently they had. Anyway, we love questions. We love questions. And you send them in to us a lot. Thank you at talkingrealmoney.com. The ones that Tom likes are, of course, the kind that he gets to print. But the part he likes even more is that every once in a while you'll send in a question that we'll look at it and we'll go, that really needs a conversation. So Tom just picks up the phone and does this.
Thanks, Don. We are going to go to Durham, North Carolina, where Pam joins us on the telephone. Hey, Pam, how are you?
Hi, Tom. I'm great. How are you?
I'm having a great day. My pleasure. How can we help?
Wonderful. Thanks for everything that you and Don do. I have learned a lot. My
Wait, there's
husband
another
and
guy
I,
on. There's another guy on the show. I'm gonna have to. I'll look into that when we're done here. But okay, I'll see what I can find out. So, all kidding aside, what's your question? How can we help you?
okay, I have a question about a brokerage. My husband and I are 57 and 59, planning to retire in about 3 to 5 years. He is likely to take Social Security starting at 67, and I probably will wait until 70. We have about $1.3 million between traditional IRAs, Roths, HSA. Most of that is in the traditional IRA. And we're looking at opening a brokerage to save some cash to use as a bridge prior to Social Security. And so we are also likely to come into some money from the sale of a parent's house in a few years, maybe $150,000, $200,000, and we would consider putting that into the brokerage as well. And so we realize we do not have a long runway, before we would be using this brokerage. So, we would want to be conservative. So we wanted to ask, what asset allocation should we use for the brokerage, or should we just stick with the high yield savings account for now?
Wow. Okay. So you threw a lot at me. So, in terms of that money, the inheritance and the other money you're saving, when would you be likely to use that? How soon would you actually start to spend some of that?
So I am thinking of possibly retiring in about 3 years.
Okay.
And so, I would want to be using that, between when I start taking Social Security at 70. So probably it would be like a time span of 7 years or so.
Okay, but you'd be starting that potentially in 3 years.
Correct.
Yeah. So, yeah, I mean, so you want to have those first 3 years probably in fixed income in case stocks were to go down. So I would figure
Right.
out, I would look at it the other way. I would say, okay, here's what we need from income from that particular holding. And I'd probably have all that in fixed income. Or maybe
Okay.
even 80% fixed income and 20% in some sort of high yield savings, so that you even have a little more conservative, because you really want to make sure that money's going to be there. You can't count on stocks, certainly in a 3-year period. You could be looking at a 3-year period where they're down. So I'd probably do it that
Exactly.
way. I'd probably say, okay, we're going to need this much, and I don't want to take Social Security until I'm 70, which is wonderful, because you're going to get obviously the larger benefit there by waiting. So yeah, I'd probably do it something like that. And then you might want to look at the whole portfolio, since it's traditional Roth, HSA, and then brokerage, to make sure that the whole portfolio still meets your need for return, your amount of risk you're willing to take, and your comfortability with ups and downs in the market, so the volatility. But that's probably how I'd look at the inheritance part of it.
Okay. And so in terms of fixed income, like money market, bonds.
Yeah, no, I would be looking at probably, a total bond, maybe BND at Vanguard. That's a very fine total bond fund. So that's an exchange traded fund that holds, thousands of securities that are fixed. They are an IOU, right? They're issued by governments, corporations, et cetera. And Vanguard runs this in a somewhat conservative manner, so that you get some yield. I'd just be curious. I hadn't looked at the BND yield in a while, but it's still showing a almost 4.5% yield, according to that's what Vanguard's telling people. So you're still making some money there, but it's
Okay.
the idea for you is it's the cushion. It's the money that again, if stocks went down, you could take the money out of that. That's my preferred situation. As I say, I probably, with that shorter runway, put 80% of the fixed income portion in something like a BND, and then 20% in a high yield savings of some kind that's still probably paying, 4+%, but it's not going to have any motion up or down, right? It's basically set. So that's what you're
Okay.
looking for, stability there. But yeah, BND, a total bond, something like that would be a good place for you.
Okay. And it's okay to have bond in a brokerage account?
It depends on your income. Really the only time bond interest per se becomes a tax issue generally is if you're in a very high bracket, 30% or higher. Otherwise, it really is not that meaningful. It's okay to collect interest from there and have to pay a little bit of tax out of the brokerage. So the difference there is you could use, municipal bonds of some kind, the municipal bond fund. You're getting less in interest, but you're not paying any tax on it. It just turns out that the difference between the interest between the two, generally, unless you're in a pretty high tax bracket, it just makes more sense to collect that higher interest from a total bond and pay a little bit of tax you may have to pay on it.
Okay. All right.
Does that help?
Well, yes, it does.
Thank you for your kind comment, which we really do appreciate. All kidding aside, it's nice, and congratulations on your upcoming retirement. It sounds like you got a pretty good plan in place.
We hope so. Thank you so much.
Thanks, Pam. You take care.
All right, we're done with our behind-the-scenes thing while we edited in that call. Now it's time for Tom to read one of his paper questions.
I know. Fun, right? Columbus, Ohio. Thomas writes us, you're moving to the top of the pile if your name's Thomas. That goes without saying. And this is lengthy, so please listen carefully. Don and Tom, I've been wanting to write to you both for a long time. I actually found your show right after your first Clark Howard commercial, and you're both on my Mount Rushmore of financial advice now. I'm going to go by again and check, see if I'm there, because that takes a lot of work. Don, I'm putting Tom right next to Dave Ramsey, even though I know you have some...
Wait a minute. What did he say?
He's putting Tom right next to Dave Ramsey on Mount Rushmore. Even though you have some strong feelings about that. But I completely agree with you guys. Dave should stick to budgets and leave investing to Don and Tom. So we're right there with you. Maybe another time we could talk about whether Rick Edelman should be removed from the mountain based on what he did at the end, becoming a total crypto bro. Rick's always on the next hot thing.
Bye, Rick.
Yeah, Rick's gone. But Clark, he says, is untouchable. And I like Clark's work. Don, you're not only the HOA president, but Celebration can thank you for promoting their tourism. You're the reason I visited back in February. It's a beautiful town. By the way, how much candy do you actually have to buy for Halloween down there?
We generally buy between 600 and 1,000 pieces of candy every year.
We had 3 people this year at my house.
We had about 500.
It's crazy. All right, here's the actual question. And thank you, by the way, Thomas, for all of those very kind comments. We do really appreciate it. Question is about AVTM. That's the Avantis Total Markets ETF. Mm-hmm. It's not AVGE. Why did they launch it? What's the actual difference between the two? AVTM is a more of a market-like, a index-like product. It's going to reflect the fact that the market is made up more of large stocks than smaller ones. It has a similar U.S. international split to AVGE, but it's going to own larger and more growth-oriented stocks versus, I'm answering this for you.
Oh, are you answering that? That's not the question. Okay.
That's not the question. This is just my response.
But you're absolutely right. It falls just slightly smaller cap than the typical large stock fund out there.
But when you compare it to AVGE,
it doesn't have the small in value tilt.
Right.
It's way off towards
He says,
growth.
why did they launch it? I think that's a reasonable question. It's money? I'm just guessing.
I think it's trying to be all things to all people. I think look at Vanguard.
We asked them at the time. They said, well, because advisors have asked for it.
Yeah. That's what I mean. It's trying to be all things to all people. If you look at AVGE, you see that it's a dramatic tilt towards small companies in value. And AVTM, have you ever heard us suggest it?
No, you have not. And by the way, it's 22 basis points. So I think you can basically go on the same thing with V as in Tom, V as in Victor, T as in Tom, VT, right?
Yeah, VT is going to match it almost exactly.
And you get that one for...
Let me look at the portfolio real quick.
Single digits?
VT is down to 6 basis points,
yeah,
6/100ths.
No offense to our friends
at
Avantis,
VT is slightly larger.
Okay, but...
That's all. That's the only difference is that VT skews a little larger cap, a little, not much, just a little. So they are almost... Well, they're very similar. Yeah, they're very, very similar for a tiny fraction. And by the way, AVGE is just 1 basis point or 1/100% more expensive than AVTM. So
if I was picking a single stock fund, it would be AVGE because it's global, because it has the small value tilts. So I'd rather have my money invested that way.
And I think the market is also doing the same thing. I mean, AVTM should be bigger, you would think, than AVGE because it's more mainstream, and they're both the same size. They have the same amount of money in them. So,
wow, AVTM has the same amount as AVGE?
Yeah, they're both $1 billion funds.
That's it, huh? Okay. Yeah. Little babies.
Well, they are actually in the grand scheme of funds.
Yeah, they're tiny.
I mean, what's VT sitting with right now? 95 billion.
And what's DRAM have? That's only been around for a while.
A little bit of scotch, just a dram.
Just a dram. Get through this program.
What's DRAM? Round Hill Memory?
That's the semiconductor thing. Somebody wrote me about that. It's only been around for a short term. It's already like the 10th largest ETF in the world or some ridiculous number.
Oh, $20 billion.
Yeah, it just has come out of nowhere because everybody's
nuts?
Invested in these semiconductors this year.
Wait a minute. Wait, the darn thing only started in when? In March?
Yeah, it's just popped up on the screen and gone straight up. The fundraising has been, because it's been the hot place to be the last couple of months, right? So guess what? Money's flowed in.
Nuts. What's in that portfolio? I got to look at it. Has 18 stocks in the portfolio.
Yeah. It's the semiconductor.
No, I take that back. 12 stocks. The other stuff's bonds. This is nuts.
Yeah. And I think it's like the 10th largest ETF already, some ridiculous number.
Well, you guys deserve the insanity you're going to get. I mean, it is mega cap growth.
Yep.
Mega cap growth. Nuts. This is crazy. This is nuts.
You want to squeeze one more in, or do you want to call it?
Yeah. Do another question. Come on.
From
We're having fun now.
California.
And it's keeping
Andrew.
me inside where it's cool. Let's go.
There you go. Don and Tom, thank you for all the good work. What do you think about a portfolio of 80% VT?
Yeah.
That's the Vanguard Total World. Plus 20% AVGV to achieve a value tilt similar to AVGE.
Not really.
It helps reduce cost of the portfolio. Is it worth it? Looking forward to hearing your take on this.
I mean, okay, if you're trying to get a portfolio similar to AVGE,
why don't you just buy AVGE?
Why don't you just buy AVGE?
I don't know. It's a lot of work.
No, AVGV does not tilt that much farther towards small and value to pull over that 80%
that
in
you're stuck
VT.
In basically large cap, even though you got international.
It's not going to do it for you. 50-50 might get you a little closer. But
there you go.
80-20 isn't going to do it. And if you want to just nail the same allocation as AVGE, I have an idea for you. Move everything into AVGE.
If you're trying to accommodate that.
That'll do
trying
it.
To get a lower cost, because VT, as you just said, is like 8 basis points or whatever, 6 or whatever.
Okay. So we're quibbling over, okay.
Yeah.
Again, our expectation based on past performance, we don't have a long-term track record for AVGE, but we do for some of the dimensional funds. And what we do see over the long haul is that you have received a more than the expense ratio difference in return, a much higher return, substantially higher in these small value tilt funds. AVGE doesn't have enough history for us to say with any confidence that they're beating the market, but over the past several years, they've actually shown a tendency to do that, but we don't like short-term data.
No, as we mentioned once or twice.
If you look back at the 3-year average annual return, that's all we have to compare for AVGE. You'll see that the index with which they're being compared returned about 19.7 over that 3-year period on average per year, whereas AVGE returned about 20.7 for that additional less than 20 basis points or 0.2%.
Yeah.
Your money ahead.
And the long haul,
I don't know about
the long haul, we would expect you to do better, but can't guarantee that. Yeah. Oh, by the way, when does this air? I hate to do this publicly, but
I don't care. I don't care if we tell them that these are recorded. You were on vacation. So we had to front load the funds. I mean the funds. We had to front. Sounds like a mutual fund.
Front running
we had
the
to
funds.
front load the show. There's my brokerage.
There's a
history
compliance
coming back.
They're going to love that one. Yeah.
No. They won't care about that. Okay. This is, when are we recording this? Let's see, 17. This is going to air on, I think, the 16th of July.
Okay, so this is a great lead-in. I've had enough pasta. I've had enough ouzo. And
because you're back
Retsine.
from Rome, and
I'm ready for your calls
Athens,
again. So dial them up. I'm home for the summer now. So
did you spend the summer in Sparta?
Do you like me the way I look in my little?
Yeah, you're all buff in your little skirt.
Wouldn't that be nice? So if you'd like some help,
because of the pasta and the ouzo,
won't help. I'll have my one thimble of ouzo, and then that'll be it. I'm going to make my daughter drink one too. Already have, I guess. So if you'd like some help, I'm back. I'm ready to go. Tan, rested, and ready, as we like to say. So go to talkingrealmoney.com, click on Meet an Advisor, and then say I want to meet with Tom.
Burned with white T-shirt lines.
It won't be pretty, you can be sure of that.
It's never pretty. Yeah, go to talkingrealmoney.com, click on Meet an Advisor if you want one of those meetings. Otherwise, just ask your questions at talkingrealmoney.com. And if you want to know where to send people, well, send them to your favorite podcast service to listen, or just send them to the website, talkingrealmoney.com, because all over the place, all these various places, almost every day of the week, we are doing this most important thing of all. You know what it is. Talking Real Money.
The opinions and views expressed on this podcast were current on the date recorded. Opinions, estimates, forecasts, and statements of financial market trends that are based on current market conditions constitute our judgment and are subject to change without notice, including any forward-looking estimates or statements which are based on certain expectations and assumptions. Although information and opinions given have been obtained from or based on sources believed to be reliable, no warranty or representation is made as to their correctness, completeness, or accuracy. Information presented on the podcast is not personalized investment advice from Appella Wealth. The views and strategies described may not be suitable for everyone. This podcast does not identify all the risks, direct or indirect, or other considerations which might be material to you when entering any financial transaction. Past performance does not guarantee future results, and profitable results cannot be guaranteed. We hope you realize that the information provided on Talking Real Money is for informational, educational, and hopefully enjoyable purposes only. The podcast is not trying to get you to buy or sell any financial products or securities. Instead, the program is provided as a public service by Appella Wealth, a fee-only registered investment advisor. Please see Appella Wealth's ADV Part 2A on our website for information regarding Appella's fees and services. Appella Capital, LLC, DBA Appella Wealth, is an investment advisory firm registered with the Securities and Exchange Commission. The firm only transacts business in the states where it is properly registered or excluded or exempt from registration requirements. Registration with the SEC or any state securities authority does not imply a certain level of skill or training. Appella does not provide tax or legal advice, and nothing either stated or implied here should be inferred as providing such advice. Thanks for listening, and please visit TalkingRealMoney.com for more information and important disclosure related to performance of any specific index or fund quoted in this podcast. And the lawyers get richer.